What a privilege. John Ryding and Robert Dahl with us right now from BlackRock as well. Bob Dahl, how do I stay invested if I'm reading John Ryding's research note?
Well, there's no question that, as John just said, we've got to get back in front of where the problem is. I think the good news of October is that the authorities recognize that they had to do something, recognizing you have a problem is halfway toward a solution. Secondly, that they had to do the banks and the sovereigns together. Until then, they were trying to tackle them separately. That's not to say we've crossed the finish line. I'm just saying the outline of the plan, that's all we got last week was an outline, is a couple of steps in the right direction. Now, Greece has pushed us back. We got to push it forward again.
Bob, in the meantime, bring up dreaded first chart. This is the emotion of a lot of the notes I get, whether it's Jeffries and Company today or whatever. Avoid this at all costs. Bob Dahl, with its tumult, how do we avoid Netflixes? Look at this Netflix chart, folks. That is the chart of the third quarter of 2011. Bob Dahl, how do we avoid these?
Well, look, Netflix was a special situation where they had a business problem. Now, there were a lot of stocks down in the third quarter, don't get me wrong, but not nearly that much. And I think what happened in the third quarter is, remember, we moved from the world is improving, looking okay, to growth is slowing everywhere, and we have a crisis in Europe. Markets are volatile. If you can't stand volatility, you're in the wrong asset class. If you look at the history of equity markets, you will find lots of big up quarters and lots of big down quarters. But you start looking at rolling 3, 5, and 10-year periods, and not always, but more likely they've been positive. You got to have a strong stomach. You got to be willing to lean into weakness and dollar cost average. You never put all your chips on black or red. You've got to have patience.
Let's bring this back over to economics. You got to have a strong stomach. Right now, there is a need for that among global leaders, isn't there?
Well, there is. But when it comes to the markets, often the times when it looks the riskiest is the best time to use that strong stomach and get invested. I actually think the U.S. is looking better because the economic data flow is improving in the U.S. Yes, we've got a lot of volatility in the equity market, but that volatility has often been a good entry point to adding risk exposure.
Bring up that quote right now, if you could, Elliot, expanding profit margins from Mr. Ryding, published just moments ago. I don't know if we've got that done by our great team. There it is, RDQ Economics, Bob Dahl. This is John Ryding. Expanding profit margins and rising profits are not the stuff that recessions are made of. Are we going to have a recession, Bob Dahl?
If the euro holds together, almost zero probability. That's a big if. An exogenous shock of a bust in Europe will put the Western world into a recession. Absent that, no, there are no signs of recession in the U.S. We just got preliminary third quarter, 2.5%. Retail sales jobs, none of them setting records, but all heading slowly but surely in the right direction. So I think the probability outside an exogenous shock of a recession is not far from zero.
Right, Bob, I want to bring up the long-term chart, and I've been doing this a lot recently, which is my phrase, you can't make money in stocks, because the gloom out there is remarkable. Here we go, folks, back to the 1920s. We had a non-decade blended over the last 10 years. Why will the next 10 years, Bob Dahl, not be like the last 10 years?
Bad 10 years are rarely followed by another bad 10 years. We started a decade ago with 2020 hindsight with a very expensive stock market, very expensive multiples, and of course we spent the last decade with earnings largely going straight up and multiples largely coming straight down. Our valuation entry point is so different today compared to where it was. All we have to do is grow with earnings. We don't need any valuation improvement for the stock market to be acceptable.
And then the key question, John Ryding, is we need to grow earnings. We know that. You're optimistic relative to the gloom and doom crowd. But we've also got to grow the economy. What's the new normal for economic growth?
We do. Well, unfortunately, it appears to be 2.5% right now. That's been the rough recovery pace. Problem is we need 4 to 5% growth in order to make inroads into unemployment. The question is, can we have high unemployment, moderate growth, and growing profit margins? And we have seen a tale of two economies that we've talked about. I think we managed to do that.
Too much information. Let's bring it up right now, team, if we can. This is an interesting chart, folks. There it is. Too much information. Stunning unit labor costs. That's an ugly series. Bob Dahl, I'm going to have you tackle this. We are a productive nation. Unit labor costs were very low as productivity was high. Is labor going to get their fair share, or is this a new stock market in a new corporate world?
With a 9% unemployment rate, I don't see how wage rates go up all that much. If you or me demand higher wages, there's somebody on the street ready to take our job. Wage rates go up and unit labor costs struggle when you have low or full employment, and that's not where we are today. So I think the labor force will continue to be one where that's not the problem for profit margins.
When you see the productivity number today, it was remarkable, way above the Greenspan enthusiasm of 15 years ago.
Yeah, but I would caution on that. It was a volatile quarterly number. If you look at the trend, productivity growth over the last year has not been that spectacular, running around 1% or so. That seems to be the trend in productivity. So I overlook these quarter-to-quarter variations. But unit labor costs over the last year up about 1.25%. Unit prices are running north of 2%. And that's where companies are getting the gain. Tight cost control, but they are getting pricing. And that's, in my opinion, because of the Fed.
Yeah, bring up chart 6 here. This is the Bob Dahl chart. America observes a corporate juggernaut, and it is pre-tax inflation-adjusted corporate profits. Bob Dahl, can corporations continue to mint money? Is there room there to cut costs like we're seeing on Wall Street now? Can we put that across the entire American economy?
Well, look, we're 3 quarters into 2011, and real GDP has been between 1% and 2% on average, but corporate earnings have grown in mid-teens. That can't go on forever. Having said that, corporate America has done a fantastic job managing their businesses in a difficult environment, getting more out of their supply lines, their distribution channels, their technology, and their people. Are there a lot more costs to cut? I think that we'll have around the edges cost cutting, and as John just mentioned, the ability to raise prices to some degree. And what we haven't said is the great gains that we've had in world market share. American multinationals are gaining share outside the U.S., in part on the lower dollar, but there are other good reasons too.
This chart's another Bob Dahl chart. I love this chart. I want both of you to comment on it. We'll let Bob go today and a busy 12 noon for him. Banks lag. Is there value there? Bob, I normalized this S&P 500 and the S&P Financial Index back before the crisis. And it is remarkable the lead weight that is the financial banks. Does that mean you own the banks here as dirt cheap, or do you still avoid them?
We're still cautious on the banks. Regulatory uncertainty, some credit concerns, and really an uncertainty as to where the revenue growth is going to come from in a world that's pretty slow growth. We're ramping up the credit machine. The shadow banking system leverage is not going to be part of the story. So we want to own some cyclicals, but the financials are not part of that mix.
Bob Dahl, thank you for coming by today with BlackRock, of course, our chief investment strategist. And